On this episode, we're going to talk about low equity injection type of deals where we're doing creative financing to acquire businesses. And this would be a business that's been in operation for over 2 years, cash flowing, and the debt service coverage ratio is in line for a good business acquisition. So as a potential buyer of this business and you're looking to leverage, how can you leverage the business acquisition to put the least amount of equity down as possible? And that could be accomplished by doing a seller carryback. Okay, so typically on a business acquisition, they're looking for 10% down, 15% down, depending on the business itself. And so the way we like to structure deals is 85% SBA financing, loan to cost, right? So 85% of the total project cost comes from the SBA. And then what we do is we get another 5%, we get a total of 10% seller carry. So then that means we're only coming in with 5% of the total project cost, right? And that 5% can be gifted by a family member. So really you can get in these deals being very creative with none of your own capital. Now, obviously, sometimes if it's a marginal deal, it's better if you put more equity into the equation, but sometimes we don't have that available equity injection. So on an SBA 7A, you need a total of 10% equity injection. Well, 5% of that total equity injection could be seller carry. Specifically, we call it being on standby, meaning that 5% is like equity the seller is leaving in the deal. So it's on standby for the term of the loan. So if it's a business acquisition with no real estate, it's going to be a 10-year term. That 5% has to be on standby for the full 10 years of that term. Okay, it can accrue interest, but it has to be on standby. So they can't get paid back until either the 10 years elapses, or you refinance year 3 or 4. There's typically a 3-year prepayment penalty on an SBA 7A. Now, if it's a 25-year term type of SBA deal, meaning it's real estate related with the business acquisition, then that's usually a 25-year AM. So the 5% on standby would have to be on standby for the full term.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day.
So as long as you explain that to the seller, and typically what I'm seeing is that the sellers, if they're getting a fair offer, they're willing to do that because they want the deal to close, and sometimes the buyers that are coming to them, they're not getting offers, or potentially they're okay for waiting for 5% till that gets repaid either by a refinance transaction, or the term of the loan expires, and then at that point they can be paid off or refinanced at that point on the 10-year mark. So kind of recapping how to be creative on these deals is seller carryback specific. We call it on standby. At least 5% of the seller's carryback needs to be on standby if you're trying to put the minimum down, which is a total of 10%. 5% of that has to come from you. That 5% can potentially be a gift from a family member. So you can be super creative. And remember, when we're looking at this total financing, the total loan to cost, we're looking at total project cost. So that means we can roll in operating capital to pay employees for 3 months, give or take, a little bit of working capital potentially. If the numbers make sense, you can build this all in. So anyways, that's a creative structure for putting as little down as possible with a business acquisition. Hope that helps.